And we think in particular this year, most of the volatility is likely to come in the first half of the year before we start to enjoy the benefits of lower oil prices and additional liquidity from central banks around the world. We think that will make the benefits or the improvement in the economies more perceptible, more tangible for investors starting from the middle of the year and heading into the end.
I basically agree with Paul. I think the end of the year we're going to have reasonable equity returns, kind of mid-single digit positive returns. And I think you are going to see volatility pronounced in the first half. I would expect it to actually pull through for the rest of the year, certainly at a higher rate than we saw last year or the year before. But in general, we think actually it's going to be a good year.
8 to 10 earnings, I think, is a tall order for this year. I thought that coming into the year. And of course, numbers have come down a little bit on the wake of the further decline in oil prices and the rise in the dollar. They're headwinds. I think one of the confusing items right now, Joe, is what's good for the economy is not necessarily good for the stock market. We can argue that lower oil prices and a rising dollar, good for the economy, but at the moment, not particularly good for earnings and therefore the stock market. The hit to energy and related earnings from the decline in oil prices is nearly immediate. The benefit to everybody else, consumers in particular, is stretched out over time. And so you have this immediate hit and the longer ramp to the upside. And that back and forth and that trade-off, I think, is giving the market and a lot of investors confusing because it's not easy to figure out.
We got Exxon out on Monday. Everyone, of course, is going to be paying attention to that. It's the largest oil stock in the S&P 500, so it's very heavily weighted. We actually have them as a beat just because the revisions have come down so drastically. Today we saw Chevron was able to beat for the same reason, so we'll be watching Exxon on Monday. Not expecting great things, though, of course. Tuesday we have Disney. I think this is a beat. We've got at Estimize, we're looking for a 110 a share. That's versus the Street, which is looking for 108. So Disney's done phenomenally well in 2014 with their movie segment, and it's going to be another blockbuster year for them. Twitter, we're expecting a miss. I don't think that's so much of a surprise. There's a lot of issues here. Their monthly active users have been down. Investors are worried about the pace of growth. It's just not where they should be at this stage. And then there's a lot of talk about possible management shakeup, acquisitions. I've heard some chatter around Google possibly. So